Welcome back to Trendlines over Headlines, the show where we break down the markets with some of the best traders and analysts out there. My name is Patrick Dunuwila. I'm the editor of the Chart Report, and I'll be your host. We've got a good one for you today. Frank Cappelleri is going to be returning to the show today. Frank is a technical analyst and the founder of CappThesis. Prior to starting CappThesis, Frank was a sell-side analyst for more than 20 years, so he's a real pro, and hopefully he can help us make sense of things. But before we talk to Frank, it's Friday, the markets are closed, so let's take a quick look at how this week played out. Hey guys, thanks for watching. Just a quick reminder, be sure to click like and subscribe so we can continue bringing you awesome content. Thanks. So all four major indices closed higher this week. The NASDAQ led again, gaining 2%. The Russell 2000 lagged, but it still managed to close higher on the week by about 0.5%. Now taking a closer look at the S&P 500, it rose for the second week in a row, and we managed to end the week slightly above the 200-day moving average. But we're continuing to be in this trendless environment, and this 4,000 level has been a real chop fest. Now, the major indices are pretty disconnected right now. The NASDAQ is trading at 7-month highs on a weekly closing basis, thanks to that strength from mega cap tech stocks. On the other hand, small and micro cap stocks are on life support. The Russell 2000 ETF IWM is back down to this crucial 170 level, which represents the 2018 highs, as well as the pre-COVID highs. The microcap ETF IWC is also back to its pre-COVID highs and ended the week at new bear market lows. So the little guys really need to step up to the plate pretty soon. Now, taking a quick look at sector performance, communications led, gaining about 3%, while real estate and utilities lagged, dropping about 2%. Anyway, that's enough for me. Let's welcome Frank back to the show. All right, Frank, welcome back to the show, and thanks for joining us today.
Thanks so much, Patrick. Always a pleasure to be here.
But we've got a ton of charts to cover, so let's step right to it. Just a reminder, we're recording this on Thursday, so the week isn't quite over yet. But Frank, the last time you were on the show, I was actually a couple days after that October low, so maybe you're good luck. Because we're up about 10% from there. You know, we're still down considerably from the highs, and it feels like we've just been kind of chopping around in no man's land. You know, just kind of chopping around that 200-day moving average for months now. It feels like, but you know, you shared this chart last week, highlighting the number of plus or minus 1% moves that we've seen this year, and you called it the most important chart. So break it down for us. What are you seeing on this chart?
Well, thanks, Patrick. Well, this is the most important chart and is the one and only one that gives us a real idea of two-way market volatility, right? You hear about the VIX all the time. The VIX, of course, only responds to the upside when there's a lot of selling. But active traders know, sitting here every day, since the really beginning of 2022, there's been intense volatility, right? And we see that by the number of big moves we see on a daily basis, right? And so looking at this chart, we see there's a lot of lines there, right? Just showing that there are 27 now 1% advances and declines for the year. And you can also see that there was only really a gap of only 4 days straight where we didn't have one, right? It's just telling you you can never really be comfortable with this market. I know we'll talk about this in a little bit, but most of my analysis is based on chart patterns, right? And for chart patterns to work, you need to break out or break down. You need to clean one of those, meaning that the pullback holds and then you get it higher. And so most of the time now, really for 15 months, it's been really difficult to find breakouts. Now we've had big rallies, of course, of multiple weeks, but even within those, very jagged and very violent movement. And so, active investors that want to get involved and use that type of strategy as a stop loss will get stopped out a lot, right? And that's when you hear a lot of times of longs and shorts getting stopped out or chopped apart, right, in bear markets like this. And if you go to the second slide there, it just gives you an indication of what 2023 has been like compared to 2022, right? Where we had nearly 130 moves 1% more, up and down, and very even too, as we can see, right? Just two more 1% losses than gains. And so that was a lot, right? One of the most in history. And now, as the year went on, of course, we got to the end of 2022 and things looked better from a chart perspective, but the amount of big moves continued. And so when we started talking about 2023, you hear a lot of people talking about how it's going to be different type of year. I wasn't really convinced, only because if you see these, they tend to linger on. And if you look at the next chart, the next table that we have from Trendlines, who does outstanding work on Twitter and shares so much, he now focuses, this is specifically just on the number of 1% declines, but as we know, there's typically the same amount of advances in down years. And what I have highlighted here are the worst market environments we've had, right, since the 1920s. And what really struck me is, if you see that the one column that says total, is that when you have a high amount of 1% declines in 1 year, it's not in a vacuum, right? It tends to kickstart something, kickstart volatility, kickstart a lot of different things we don't usually see in mature uptrends. And that's why, if you think about what happened during these times, right, the Great Depression years, 1970s, of course, which this time is being compared to, Great Financial Crisis, internet bubble burst, same type of thing, kind of linger, where those years were different, but sitting through them, that it wasn't one of these like 2017, 2019 type environments. And just one more fact before we go on to the next topic for that.
Sure.
To give you an idea of what it was like, even in 2019, remember, we had a very good fourth quarter of that year. So from the middle of October all the way to the end of January 2018, we didn't have 1% move up or down, right? And the market was straight up. So that's the type of context we have to think about, where, we're making new highs in different areas possibly, but not nearly close to getting to that environment again right now.
Yeah, and you don't really see it show up in the VIX too much, but 27 plus or minus 1% moves, and we're not even a full 3 months in yet. That seems like a lot. And, I think on this table, what's interesting is you look at a really easy year like 2017, it only had 4 plus or minus 1% moves the entire year. Is that right?
Yes, he just has 1% declines on this, but it was only 8 total, 4 up and 4 down, right? And that was extreme to the other side, but that is a type of environment where, as you know, an uptrend, biggest characteristics of an uptrend are low volume, low volatility, and very small moves, which clearly we're not near close to right now.
Well, Frank, I know you look at a lot of chart patterns. That's kind of your primary way of analyzing the market. So what are some of the patterns that you're watching, some of the most significant ones on the S&P?
We're always trying to identify breakouts when they occur, right? And again, it's been very difficult. And this is just an indication of a recent one, just in the last 2 days or so, where you had to come back, have a little bit of a pause, and then, right above that, the area we have highlighted there was where we saw the breakout from. Again, the Fed day happened and it came back in. And today it was all over the place as well, which it's already being tested. Whereas, again, you can compare it to what happened even 2020 when we came out of that. I remember specifically talking about it in the early April, where it was the first identifiable bullish pattern. It never got tested again, right? And went up. So in 2021, even more so, where there were small consolidation patterns and they continue to go higher. And so this is very difficult. And I've been really talking more about, it's probably more beneficial now to talk about a building pattern and identifying where it can get up to resistance, because once it gets through resistance, it really hasn't paid off to chase a breakout right now, at least for the S&P 500.
Yeah, it seems like, back to what you were saying about some of the volatility, it's causing a lot of those patterns to just fail, right?
That's right. And even the multi-week runs we have that end up working out, waiting for a crisp pattern. We only have one of them really worked this year so far. It's been very frustrating to that sense. So, frustrating for me was I relied upon that during those good years, of course, but then you have to adjust to the market environment that we're in, right? And that's why paying attention to the frequency of those big moves is important, because once you see those, the frequency of those really die down is when maybe you can trust those patterns again.
Yeah, and it seems like, all eyes are on the 200-day moving average. As I mentioned, we've kind of just been chopping around there for months, but are there any other indicators that you're watching?
Well, on one of the slides there, we have the Spider ETF, with the anchored view up. Now, I know you had Brian Shannon on, wrote a wonderful book about that. I just got it myself. And, has a point, because just on a side note, in my previous life, I was a sales trader for 16 years. And that was one of the key algorithms that the clients used to use, and we used to use as traders as well, on a daily basis. And you can understand why, because, it's a form of support and resistance with volume tied to it, right? If you think about support and resistance, how does that really get produced? Is by institutions and a lot of orders going through at certain points. And when that point gives way is when, you can see a breakdown or break out. So that being the case, I've started using this a lot more recently, and it's been really helpful, especially now. If you can see the two that I've chosen here, just tied to the February 2nd high right there and a March 13th low. And really, since over the last week and a half or so, they have capped the top and bottom of this move. And so as you can see, they're getting closer together, right? So they're not going to go and converge anytime soon, but getting closer. So the more they pinch and the more we have these big moves, you have to believe that one way is going to give at some point. And I think at that point, maybe we'll see the exaggerated move.
So I want to look within the market for a second, and it's been a pretty bifurcated tape. Mega caps have really been doing a lot of the heavy lifting, while you go further down the cap scale and the indexes get weaker and weaker. In fact, micro caps hit a new bear market low yesterday, and I just couldn't believe that. Typically you want to see the smaller cap stocks doing well, and you could view this a few different ways. It's kind of similar to growth versus value, or NASDAQ versus Russell 2000. But I want to focus on equal weight versus cap weight, because it's on track for its worst month. Equal weight's on track for its worst month relative to cap weight. So help us make sense of this ratio. Do you view equal weight underperforming as a bullish thing or a bearish thing, or just kind of neither?
Well, it could be bearish, and the major reason is that means, of course, that a lot of the stocks underneath the surface that don't have a lot of weight, of course, are doing worse. And so, if you see more of the financials break down, if you see more of energy, it'll start to hurt more, and that will weigh on a lot of investors' minds. And I think at that point, they'll want liquidity, right? And where's the biggest source of liquidity? The mega cap stocks, they're doing well, and if that type of thing creates momentum, that's how that type of thing can roll over. And we saw it really in that initial week from 2 weeks ago when the first news of the banking crisis came out. Everything got hit, right? Right across the board, boom. 98% of the stocks were down for the week, right? So that type of thing could reverberate again. And so we saw that, like you mentioned, kind of separate themselves recently, because I get, with some of the support that the market got, traders started to think that the worst case scenario, at least, was behind us, and they'll start to go into that. But as we go on and seeing today some of the financials hit new lows again, I think that's going to weigh on investors' mind, and it's going to be very difficult for me to envision an extended period of time when you have, say, technology, telecom, and discretionary going one way, and all the other sectors going the other way.
Yeah, and I'm just wondering if you could break this one down for us. It's just kind of a zoomed out look of the previous chart, equal weight versus cap weight. So tell us what you're seeing here.
Right. What struck me about this, Patrick, is that, we would assume over time that S&P outperforms RSP just because of the big names in there. But really going back to what this chart is almost 20 years, it's the opposite. Right. There are times when it doesn't occur. So it just tells you that there's a lot of different rotation going in that we probably forget about as we get past it. And really the only time when you had in a longer period of large cap outperformance was you see during that time from 16 to right around COVID. But I think the most important or the most interesting part of this chart, to me at least, is that you can see back in, say, 07 and 09, and then 15, 16 or thereabouts, and then again in 21 and recently, that you've had two different rollovers in that ratio relatively close together, with the second one being worse than the first, meaning that the current one we're having right now worse than the one we just had a year and a half ago. The question is, how much more does it have to go? Because you see in the past here that sometimes, especially in the grand financial crisis, of course, it got really exacerbated. So, the first step, of course, is seeing some sort of pattern develop in some of these names, and we can talk about those in a little bit. But right now, you're really in a spot where It's like support discovery mode. And again, it's more for the financials, but I would relate it to this scenario as well.
Let's take a look at the financial sector real quick. It seems like every technician I know is watching this level on XLF, that 30 level. It was the 2008 highs, 2018, 2020, and we're testing it for the third time now. So it's definitely skating on thin ice there. But Frank, what's really interesting is, I don't know if you saw this, but they recently reconstituted the XLF and they made some new additions. They added Visa, MasterCard, PayPal, and a few others. And before Visa, MasterCard, those were in the tech sector, and that never made sense to me. Why are these credit card companies in tech? And everything nowadays is tech, so they kind of have to reconstitute it, reclassify things. But I find it really interesting that they did it right as financials were kind of skating on this level. Do you think they were watching this chart, or?
I would say no. But,
you think they had any idea how important of a spot it's at? Maybe they called up the guy and said, time, add Visa, MasterCard.
That's right, exactly. Let's expedite this just a little bit. It's interesting because I agree with you. And I think anyone who looks at these names realizes that they should be in financials. Who knows why it took so long? But I think the bigger thing to consider is that, what that means to the XLF right now. We know that it diversifies it a little bit more with so much bank exposure in there. But the other concern is that, now it's part of the XLF, right? And so in a situation like this, you can consider a big institution that owns maybe some exposure to financials through the XLF, ETF, and they've just had enough at this point. Now, all of a sudden, they're selling the XLF, which is in turn selling everything within it, right? Banks and all these new components included. And so they could potentially get hit even harder just because they're now in a different sector, right? As compared to technology and force. Now, we don't know that right now, but I think it's something to pay attention to going forward.
Yeah, I'd really like to think that they are watching that chart and that they did step in at the nick of time. But I want to talk about yields real quick because we can't talk about financials without talking about yields. And it seems like the 10-year is kind of retesting this 3.4 level. It's acted as support a couple times already in the last few months. Do you think it'll hold up again, or do you think yields go lower in the short term?
Well, all depends on what the signal I think traders want the Fed to hear at this point, because it continues to lead, and I think if this has been teetering on there, it looks like it's going to break, and maybe we see a fake breakdown. But I think really, even if it just breaks down a little bit and stays relatively even, I think it tells the Fed that it's time to, at minimum, pause, if not cut. And if you go to another chart we have there, it shows a 10-year yield with the effective Fed funds rate there, and really there are numerous times over the last number of years when the 10-year yield reversing marked potential inflection points from Fed action as well, and always moves before, and the Fed gives us some time. But I think the biggest example of that, of course, was just in the last year and a half when the 10-year yield started rising, continuing to rise. There were chatter of inflation. Fed didn't want to believe it, called it transitory for a long time, and then by the time the data started to pour in, and the 10-year yield was so far above what the Fed funds rate was, it was undeniable they had to do something, right? And so right now, of course, as we know, continuing to raise rates here, possibly pausing, not willing to give in to the fact it's cutting rates. So the 10-year yield, or the investors that move that want to really send the signal that we're going to see that 340 level break.
Yeah, and what about longer term? Do you think longer term they're still headed higher, or?
I do. I think we made generational lows. No way we're getting back down to zero. When you see that chart there, we talked about this last time, I believe, but what struck me last year during this huge advance in yields was that you got that overbought reading on a monthly basis for the first time since the 1980s. But if you go back further than that, the first time you got it was really in the 60s, but then kickstarted 15 years, 20 years of higher rates, which I think we're due for, but it takes time, right? We can see the yields come back in and still make a higher low at some point and still move higher. And I really do think that this period is going to be more similar to the 1970s. I think we touched on that last time as well, where you had, the S&P moved, basically did nothing for 10 years, where we had really back and forth, strong moves and strong, up and down for a long time as a yield continued to tick higher. So I think that's the type of thing we have to be, on look for. And again, if that tends to happen, you're probably continuing to see those high frequency of 1% moves we talked about earlier.
I want to move on to gold here. It really looks like it's going to make a new high, or at least it looks like it wants to. And it's back above 2,000 for the first time in about a year. But, gold reminds me of the boy who cried wolf. I mean, this chart has looked great for like 3 years now, but it hasn't been able to make a new leg. So do you think the third time's the charm? What do you think?
I do. I think it will break out. I mean, this is like every technician's dream at this point, right? Everyone loves it. And so maybe it's self-fulfilling prophecy at that point, but I think you have to respect this. And again, also respect the fact that you could reverse lower from that point again. But, if you're like Peter Brandt looking for patterns, right, without thinking about anything else, and every try is a new one, right? And so with a breakout, even the ones that end up failing, you got to respect it as long as it goes through, and just manage your risk otherwise. But that is the undeniable large bullish pattern. And again, in an environment like this, we all know the reasoning for it, that it should be a safe haven, right? It should be the quintessential safe haven at that point. And I think we should continue to watch it. But if you zoom out just a little bit on the weekly chart too, you see that it is overbought again. And the last few times it came up to this point on a weekly basis overbought, it did pause again. So we'll see. Maybe it has to take another little break to make sure it's right. But I do like its chances.
Yeah, I mean, it has been a heartbreaking chart. As you said, it's looked great for a while. And as frustrating as those past 3 years have been, I think you could view it as constructive. We kind of formed a little handle, if you want to call it a cup and handle. I mean, would you call that a cup and handle?
You call it a cup and handle. I have a look. It appears on my chart like an inverse head and shoulders pattern. I don't get too crazy about labeling things. If you can identify, it's a bullish pattern. You can look at it, and as long as you can identify where the risk is in that, I think it's interesting. The other part of it, of course, is that we've been waiting for this to break out, but waiting in gold last year would have given you some good outperformance based on, compared to mostly everything else. That's for sure.
Yeah. Well, Frank, before you go, I want to get your thoughts on digital gold, so Bitcoin here. It's holding up relatively well. I mean, last week was its best week in, I think, 4 years almost. It jumped like 26% or something like that. But what do you think about it here? Do you think it'll be able to rip through that 30,000 level?
I mean, I'm bullish on Bitcoin as long as it continues to hold around 25,000. And we know how volatile it is, of course, right? But, this longer term chart just shows us, what it's gone through over the years. And, the biggest thing that stands out, Patrick, is that it continues to make higher lows, right? Volatility notwithstanding, that's the longer term picture. And I think, it's an important spot here. And we keep on saying it, but it's been hugging that uptrend line for a while now. And, whether it goes to 1 million in the next 30 days, like some people are saying on Twitter, I don't think that's going to happen. But the most important thing is, continuing to respond to pullbacks like this where it should, and it should be doing that again now. And don't forget, this is all coming from when sentiment was as bad as it has ever, been really in recent years. Back in the summertime, it's continuing to hold the whole time, like you mentioned. And that's been going through when, the market was still going down to an extent. And that was, as it started to come back. So, the other part of Bitcoin is you hear all these different arguments of what it's most correlated to and what market it does best in. And I don't think anyone really has a handle on it just yet. But the longer it continues to hold in there, I think, over the years, I think the more sponsorship we can get from people outside of just crypto.
Yeah. And how do you interpret Bitcoin's strength in terms of, the macro picture? Do you see it as kind of a sign of risk appetite, or is it speculative froth?
It's a good question. I mean, I think of more of it as an alternative asset now, where, we've heard that in the past, but just having a small portion of it helps you diversify just a bit, because you never know. Obviously, you got hurt really badly during COVID and during the worst year last year, of course. But, this year outperforming again. So, to an extent, it is its own animal. But I think, where it gets its most respect, if you will, is when it tends to hold in there with gold doing the same thing in periods of market turmoil like right now.
All right. Well, Frank, I think we're running out of time, but thank you so much for coming on. It's always great to hear your perspective.
Patrick, thank you so much. Can't wait to do it again.
Awesome. Have a great weekend.
Thanks, you too.
Thank you guys for watching. If you enjoyed the show, be sure to click like and subscribe, and we'll see you again next week. Thanks.